All right, it looks like we're getting a nice quorum of participants, so we'll go ahead and get started. Thank you so much for joining us today for our webinar on M&A deal terms. We'll be presenting data from the SRS Acquiom 2023 M&A deal terms study, which looks at the markets 2022 and before, but we've also got some preliminary 2023 data to share with you. But most importantly, we've got some great panelists to tell you why these numbers are important and give you some context behind what these data points actually mean for the greater market and for deal making. So a huge thanks to our partner today, the KO firm, Koenig Alsting, for partnering with us and presenting on this data. First, I'd like to start with introductions. So first up is my colleague here at SRS Acquiom, Anahit Samarjian. You want to go ahead and introduce yourself?
Thanks, Kip. Hi, everyone. Really pleased to be here. I'm an attorney at SRS. I work in the shareholder advisory group, which is a group that helps selling shareholders post-closing deal with all the issues that may arise, including claims from the buyer, tax issues, purchase price adjustments, and a whole host of other fun issues as they pop up. Really happy to be here today. Looking forward to this great chat.
Great. Thanks, Anna. My name is Kip Wallen. I'm also with SRS Acquiom. I head up the thought leadership practice for our firm. I'm a M&A attorney by background, or I like to say I'm a recovering M&A attorney at this point. But right now, my focus really is on putting helpful resources out for M&A practitioners. So things like our deal term study, various thought leadership pieces, and we're always looking for feedback and new ideas. So if there's ever any data or something of interest that you'd like to maybe do a little deeper dive on, feel free to reach out. We're always looking for those ideas for new content. And last but not least, from our KO partner today, we've got Jon Taylor. Jon, you want to introduce yourself?
Hi, everyone. I'm Jon Taylor. I'm a partner here at KO. I've been practicing law for 25 years, doing M&A during that whole time as part of my practice. If you're not aware, KO, we're a corporate transactional boutique. We focus on M&A, venture capital, private equity, commercial transactions, and data privacy. I'm really happy to be here and looking forward to today's chat. Also, I'll point out for any attorneys on the call, we have CLE credit is in process, and so we'll send that information out once the CLE credit has been approved.
Yes, thank you, Jon. You read my mind. So just a few quick housekeeping things. Well, actually, I just want to say it's great to partner with KO. The K in KO, of course, stands for Koenig, which that just happens to be the last name of our founder and CEO. I wonder if there's any relation there. So it's always great to partner with KO, a strong connection between the two firms here. So yeah, just a quick housekeeping thing. Since Jon mentioned the CLE, that is pending for Colorado. So there'll be a follow-up for those attorneys on the call who would like to seek CLE credit. We're definitely going to cover a lot of substance today, so it definitely qualifies for that. Also, if you have questions during the presentation, please do use the Q&A function of the Zoom platform. I'll keep an eye on that throughout the presentation and try and feather those in as we're talking with our panelists. And we'll also reserve some time at the end for Q&A as well. So please do use that Q&A box. We really like these to be as interactive as possible. We want you all to get out of this what you want to hear, what you want to know, and make this the most meaningful for you as we can. And lastly, we will follow up after the webinar with a copy of the slides. So if you'd like to see a PDF of the slides, we'll have those in a follow-up email. So look for that in the coming days or next week in your inbox. Just for those of you who might not be familiar with SRS Acquiom, just really quickly wanted to introduce what we do and our role on M&A deals. So we're not actually a law firm. We're a service provider. We started about 15 years ago. Paul Koenig, our founder, realized he had a client at the time when he was in private practice who was serving as a shareholder rep on an M&A deal, a private M&A deal. So that shareholder rep is the person who kind of comes in post-closing and represents all those former security holders of the target, because now, you know, the target company, maybe the management team, even the lawyers, right, all those service engagements, that all belongs to the buyer now. So who's looking out for these former security holders? That's the role of a shareholder rep. Well, this individual ran into a snag when they realized that they couldn't get, I think it was a phone, like from Verizon, because they checked his credit and he had a lawsuit in his name because he was named in a lawsuit as the shareholder rep. So we're like, that doesn't work. You know, we don't want these individuals tied up and things like that. So we founded this idea of a professional shareholder rep, or having an entity serve in that capacity. So we've been doing that for about 15 years. The firm started in 2007 with that shareholder rep role. And in that role, this is where we get all of our data from. So when we're engaged as a shareholder rep, we get access to all those closing documents, and it's from that information that we pull all of our deal points today. So we aggregate and anonymize the data and put it back out there in the market to hopefully be helpful for all of you deal makers out there. About 10 years ago, we added financial services to our firm. We realized that, you know, not only having a professional shareholder rep can make deals a little bit more efficient, but we saw the closing process in desperate need of some efficiencies. And so we introduced some cool technology platforms that allow you to bring the solicitation and payment process online. We also offer escrows. We can do enhanced stockholder solicitation. So not just those letter of transmittals, but, you know, if they're 280G notices or accredited investor questionnaires, anything that you need to solicit from the shareholders. Building on our technology platforms, about a year ago, we now offer a virtual data room. So continuing to build out our technology suite of offerings to help M&A deals. And we also have a loan agency team. So if you have a you know, a bilateral or syndicated loan that needs an agent, in an M&A context, if you have a deal maybe with a seller note, and if you need an admin for that seller note, our loan agency team can help with that. So in our role, these various roles across M&A deals, we just see a ton of deals. We're actually up closer to 7,500 deals that we've been engaged on. About 3,500 of those deals were the shareholder rep. And so those are the deals where we're able to pull all this really great deal terms data from that we're going to talk about today. So this is a nice jumping off slide because it just gives you an idea of where the data is coming from and how much of the market we're seeing. Our agenda for today, just really quickly, I mentioned a few things about SRS Acquiom and Jon mentioned about KO. I'll mention just a few things about the data and then we'll get right into it. So we've got some really interesting data that we pulled. We can't cover everything that's included in our deal term study, but we kind of pulled out the highlights for you today to talk about. So starting with pre-closing matters, we've got things like what consideration is being used, like use of buyer equity and financial structures like earnout provisions. Then we'll talk about some of the closing matters, you know, things that kind of come up post-closing. So the purchase price adjustment or working capital adjustment, also getting into some of the indemnification provisions and claims data as well. So we've got a jam-packed agenda. I want to get right to it. So just a little bit about the data itself. When we put out our studies, we like to present multiple years of data so you can get an idea for kind of ballpark ranges, year-over-year trends, kind of what's been, you know, how the market is evolving and what's market currently. So that's over 2,100 deals in our latest study. So it's just a really nice comprehensive data set for private target M&A. And the vast majority of these are not publicly disclosed. So there are some other great studies that are out there. The American Bar Association puts out their deal point study. They're pulling from publicly disclosed data on Edgar. So, you know, US public entities making material acquisitions. We view like their study is complementary to ours, right? Just understanding that we're sort of pulling from two different data sets. So the data we're looking at today really is the private M&A market. Most of these are not publicly disclosed deals. It's a nice representation, right? We've got different buyer types. About a third of our deals are technology deals. So not so much in the most current market, but typically technology usually dominates M&A or is the biggest sector. So that's what we see in our data as well. We'll talk today a little bit about reps and warranties insurance. We see RWI on about 40% of our deals. That's maybe a little lower than the broader market, but RWI usage is coming down in the recent market. It was 44% in 2021, so it came down to 40% last year. And then just the last thing I'll point out about any of these data studies, it's important to remember that, you know, while these are really great for these ballpark ranges or kind of year-over-year trends, just because we're presenting a particular mean or median doesn't mean that's what's going to be right for your particular deal. Every deal is unique, right? It's why you hire M&A advisors and have attorneys help you out with these things. So just because we're presenting a particular data point doesn't mean that's what's right for your specific deal. And along those lines, we also make our data available with this online tool called Market Standard. And I like to point this out because Market Standard, it's free to register. It's on our website. And you can slice and dice the data. So you can sort of go by buyer type or industry for the seller or maybe deal size. Again, anything that gets the deal a little bit closer to what the data, a little bit closer to the deal you're working on. So definitely check out Market Standard. It's a great place to find all this data. All right, so jumping in, starting with buyer type. This gives you a little overview of what's in our data set. So you can see that top teal category, those are US public buyers. So those are kind of those strategics, maybe even serial strategics in that category. Orange, we've got US private equity. Yellow are just US private, either portfolio, like PE-backed portfolio companies or just independent private companies. And then on the bottom there, we've got gray for our non-US based, or kind of indicating cross-border activity. So one thing that's interesting that we're seeing in in 2022, by the end of the year, it really was the financial buyers that were pretty active. We saw a lot of private equity. In fact, if we even break down that private category between PE-backed portfolio companies and non-PE-backed private companies, you can see quite a few portcos were active in the market last year. So far in 2023, that trend is sort of swinging the other way, and we're seeing more strategics be active. So even though it's a down market and there's not as much deal volume, we are seeing strategics kind of taking a bigger piece of the pie, even though the pie itself is smaller in the current market. And Jon, I'm wondering, in your practice, I know you work with a lot of entrepreneurs and companies that are looking to make that exit. Are you, in terms of what you're seeing on the buy side, are you seeing more strategics kind of sniffing around at deals, or is it a pretty equal mix between strategics and financials?
I think on the strategic side, we're seeing a lot of on the sort of PE-backed strategics, so that they've got the private equity money behind them and they have some gas in the tank that they're able to spend, versus I think a lot of the private strategics are being pretty quiet, that are not PE-backed, because they're also conserving cash. And then, the public company strategics are always sort of out there looking to pick up some deals also.
Yeah, I think that's a great point. The company's cash positions definitely having a big impact on M&A, and also just the credit markets, right? Credit is very expensive right now, and so that's definitely affecting buyers' behavior. For transaction values, again, just to give you an idea of what we have in our data set, 2022 saw a softening of valuations. So these target companies, not commanding the purchase prices that they would have otherwise gotten in a very up market or a robust market like we saw in 2021. And we'll see this theme as we go through the data today. 2021 was really an outlier year. It was just record setting in terms of deal volume, valuations, the pace at which these deals were being made. And it had a huge impact on deal terms, we'll see. In 2022, that sort of hot market cooled pretty dramatically. And we saw not only softening of valuations, but a lot of these deal terms will see some shifting toward more buyer favorable trends. And that's a trend we're continuing, that's continuing even more so into 2023. We're seeing even more buyer favorable terms coming on the deals in 23 so far. So interestingly, with valuations, though, in 2022, even though valuations were down, they weren't down so far that we were seeing like a ton of distressed M&A, or even distressed adjacent M&A. Whereas like in 2023, I think we are starting to see some of those more maybe distressed deals, or where target companies are running out of cash, right, Jon, like you mentioned. So I'm just curious, in your practice, Jon, are you starting to maybe see a little bit more of the, maybe not necessarily fire sale market, but just deal targets that are pretty motivated to make a sale given their cash position or just overall performance for the year?
Yeah, I think it's pretty interesting that your under 25 million has gone up pretty substantially between 2021 and 2022, and I think it'll probably be higher in 2023. And a lot of those, I think, are sort of VC-backed companies that are still have a large number of shareholders, and they need a shareholder rep, but they're exiting at those sort of lower valuations. That doesn't surprise me at all to see that data. And that's what I was saying earlier. The public companies and the private strategic companies that have cash in the bank are definitely looking to pick up some assets and employees at a discounted price.
Yeah, and also, we hear, obviously in the news, there's been a lot of focus on sort of the heightened regulatory scrutiny that M&A is facing, especially these last couple of years. Are you seeing that as a factor? Are buyers maybe avoiding those larger deals to avoid those regulatory threshold amounts?
I don't think that they're letting the regulatory drive the transaction. I do see it come up, especially with some of the events that are happening in the world right now, buyers from China or from China in particular are like hitting higher regulatory hurdles. So that can be a concern depending upon the transaction.
Oh, interesting. Yeah, the jurisdiction certainly can have a big impact there, definitely. And Anna, thinking about these deals on the post-closing side of things in terms of, PPAs and indemnification claims, now that we're seeing a lot more smaller deals, can we expect the claims environment to kind of be a little bit, maybe less active, right? Do smaller, just basically, I guess what I'm asking is, are smaller deals simpler in the fact that we don't see as many post-closing issues come up on those, or maybe it's the opposite. I'm curious how smaller deals maybe fare differently in the post-closing environment.
I think it's a case of yes and no, Kip, because when deal value is lower, this provides less of an incentive to fight things out because there's just less money to fight over. However, along with lower deal values, especially if it's a distress sale, there are usually less favorable terms negotiated for the sellers as well. This might be broader indemnification rights for buyers, less audit or informational rights for the sellers if there are any future earnouts or milestones to be had. And so this leads to an environment where a buyer might more easily make a claim that they might not make if it was a deal that was negotiated in a time where sellers had more leverage on their side. So sometimes with a smaller deal, there's a smaller expense fund set aside, and it's just not worth it for the sellers to create a dispute or to seek out a dispute post-closing. But it also, like I said, can go the other way if there are less seller favorable provisions negotiated into that deal to begin with.
Yeah, and I just to add on there, I think from my perspective, oftentimes the smaller the transaction, the more complicated the transaction oftentimes, because you've got things like equity as part of the consideration. In addition to cash, you have management incentive plans that are management carve-out plans potentially, and earnouts are often part of the transaction also to try to get the price up a little bit. So oftentimes the smaller deals tend to be some of the more complicated.
Oh yeah, interesting. So both on the sort of transactional or negotiation side, getting to closing, and then Anna, I like your answer. It's a very, very lawyer answer, both yes and no. But I think you're exactly right. It kind of depends on the specific deal. But yeah, so something to kind of keep in mind that even though we're seeing more of these smaller deals in the market, that doesn't necessarily mean they're easier or faster deals to get done. That's interesting. We did get a question so the data presented on this slide, the percentages are based off of deal counts, not dollar value. So 13% of the number of deals we saw in 2022 fell in the $250 to $750 million bucket. So this data is broken down by deal counts as opposed to dollar values. All right, moving on to some of our deal economics data, starting with consideration type. So kind of how are buyers paying for these deals? And you can see from the data on the screen over the last few years, there's been quite a notable upward trend of buyers using their equity, either in combination with cash or, in some cases, an all stock deal. So our orange slivers in the middle there, those are our all stock deals. The yellow on the bottom, those are all cash deals. Cash does remain king in private M&A. But this noted trend, especially in the last couple of years, seeing more deals using buyer equity. In 2021, not surprising with really high valuations. I think, buyers that maybe just didn't have access to cash or the ability to leverage cash on a deal, maybe had to resort to their own equity. Plus, the public markets in 2021 also did very, very well, just like private M&A did. And so, if you're a public entity, why not use equity? You're pretty much printing money at that point. In 2022, I think it's a little different story. I think it was really the fourth quarter of 2022, and this is kind of continuing into 23 when the credit markets really started to feel that crunch. And I think buyers were looking to their equity, just given the fact that credit was so costly to get deals done in the current market. So Jon, I'm interested on the deals that you're working on when you're negotiating them. If the buyers or the parties generally are going to use buyer equity, does that add a lot of complication? I mean, what are some of the main things that the parties should be considering or thinking about if they're contemplating buyer equity on a deal?
Yeah, so if it's a public company, which is more typical where they're using equity as consideration, obviously you want to make sure that you can sell, like what are the transfer restrictions on that equity, both from a securities law perspective, is there a holding period or is it registered equity that you can sell right away? And then are there in addition any contractual restrictions on disposing of that equity? Because from the seller's perspective, you want that to be equal to cash as quickly as possible, typically. On the private side, it's usually the complications are around how do we value the equity? Are we receiving common stock at the last round of the preferred stock's price, which may no longer be the correct price anymore? And because that's oftentimes a buyer trick is to issue common stock but value it in terms of like a top line number at the last round of preferred. And so we see that a fair amount also.
Oh yeah, interesting. Yeah, I think from my colleagues and like Anna's colleagues, I hear the valuation issue comes up post closing. I think quite a bit on especially if the equity is in any way tied to repaying or paying for indemnification claims. So yeah, Anna, what sort of if a deal is structured with buyer equity when it comes to post closing matters, how can that buyer equity complicate, say, like indemnification claims?
Sure, Kip. Even before you get to a matter of indemnification, if there's a lockup period and the share prices start to slide, we hear from a lot of shareholders who get very nervous and want to know, when does this lockup end? Or wait, I thought this lockup was only going to be a month, but now you're telling me it's 6 months. And so a lot of questions come up as a result of people seeing the value of their consideration going down, which is what Jon was alluding to. But then when you do get to indemnification, if you have a buyer and seller that have set aside indemnification escrow accounts in shares, or often in both cash and shares, setting aside the actual substantive question of the indemnification claim, you end up with these additional issues in dispute based on can we pay all of indemnification in shares because the share value is down. So we'd rather dispose of the shares in escrow than the cash in escrow. And on the buyer side, they want the opposite. They want to try to stake as much of a claim as they can in the cash escrow and let the sellers keep the shares. And so these things become issues when the parties probably, or depending on when the deal was done, didn't foresee that the question of how indemnification or post-closing matters would be settled would turn into a dispute about cash versus shares, in addition to the actual substance of it.
Yeah.
Oh yeah, that's interesting. Sorry, yeah, Jon, go ahead.
As we often represent sellers in the public company, where we're a private company selling to a public company, and the provision that we always try to get is that it's you value the stock as of the day of closing. And then if there's an indemnification claim, the sellers have a choice of either paying in stock or in cash if the price has gone up of the stock, because the buyer shouldn't be getting a windfall just because the value of the stock went up. We sometimes win that argument and we sometimes don't.
Yeah, and we love. Sorry to interrupt, Kip. I was going to say, when we're representing and responding to selling shareholders who have these concerns, we love when someone like Jon has negotiated such a provision in there for us, because it makes it a lot easier to fight for the interests of the sellers when we don't have that provision. Or oftentimes you might end up with the buyer has absolute discretion on how the claim is paid, and they get to choose entirely whether they want cash or shares or a mix. The sellers are left without much say in how that gets paid out.
Yeah, I think that's a really good point. And I think, a recurring theme in all of our thought leadership, and I think a lot of these webinars, if you attend them, is careful drafting goes a long way and is really an important thing to focus on. Anna, when you were kind of talking about the valuation issues, I was reminded a colleague of ours, Andrew, was mentioning a deal where that kind of scenario exactly happened, where the value of the stock was pegged to the whatever it was worth at closing. But then the value of the stock doubled. And a year later, when there was an indemnification claim, the buyer was requesting that the claim be paid in stock, meaning that the $1 million claim essentially became $2 million worth of value, or the stock that the sellers would have had to return would have been worth $2 million. So essentially a $1 million claim turned into a $2 million claim. And what was interesting about that one is, the $1 million claim, they might have sort of said, okay, yep, that's a valid claim, we'll go ahead and pay it. But now that it was double the value of the claim, the sellers kind of dug in a little bit more, right? And maybe a little bit more of an emotional response. So yeah, these valuation issues, I think it's really important for parties to think through them ahead of time. And like Jon mentioned, negotiate clear language in the agreement. All right, let's move on to earnouts. I always love talking about earnouts. They're very, very interesting, and they're sort of the headline of kind of how the 2023 market is distinguishing itself from the 22 market, and certainly what we saw in 21. We're seeing more earnouts. We're seeing bigger earnouts, more complicated earnouts. So this is when there's some portion of the deal consideration is basically made contingent. It is tied to some sort of post-closing performance, some sort of metric or milestone. So you can see our data here is showing us how often deals include an earnout structure. It's not a majority of the time. The minority of deals have an earnout. We pull out life sciences deals just because life sciences, they're sort of their own genre of M&A, and they're much more likely to have an earnout structure, particular biopharma deals. So we pull that data out just because it would skew it so dramatically. Interestingly, tech deals are less likely to have an earnout. So in 2022, only 14% of technology target deals had an earnout. So the sector can make a big difference here. Buyer type can make a difference. In 2023, that number so far for the deals that we've seen that have happened this year, that number is closer to a third of deals having an earnout. So really interesting that in the current market in 2023, such a high prevalence of earnouts. Higher than I think we've seen sort of in recent history, and these earnouts have more triggers or metrics tied to them, meaning the contingent consideration isn't tied to just hitting one revenue goal. For example, there may be multiple metrics lined out, and you can see on the right there, majority of the time there are multiple trigger events, and this data is from 2022. In 2023 so far, it's even a little bit higher. It's like maybe closer to 2/3 of the earnout structures have these multiple milestone structures. So more earnouts, bigger earnouts, more complicated. You can see revenue is the most common metric that we use here. So kind of while you're kind of digesting everything that's on the screen at the moment, Jon, I want to kind of start with you. As someone who works with a lot of sellers, do you always try and avoid an earnout, or are there instances where an earnout can work out well for a deal structure?
So, we represent both buyers and sellers. Obviously, from the seller's perspective, you want to avoid an earnout, but oftentimes it's inevitable because you want a certain number for your company, and the buyer's not willing to pay that unless you hit the numbers that you're telling them that you're going to hit. And so, in order to get to that number that you think that your company's worth, an earnout is sometimes inevitable. On the buy side, obviously, it's a great tool to assure yourself of what you're getting in terms of what you're paying for revenue or EBITDA numbers. On the sell side, we represent a lot of companies who are selling to private equity funds or private equity-backed portfolio companies. They absolutely love earnouts because they're number crunchers and they like EBITDA earnouts most of all. And so we see a fair amount of those. In this market, we've also seen some deals where the consideration is mostly earnout, where there's a very small payment at closing, and then most of the consideration is tied to an earnout because it's basically the company's going to shut down or they're going to get acquired, and that acquirer is not willing to pay a lot, but they are willing to pay if things turn out as they're advertised.
Oh yeah, that's interesting. Yeah, so since you mentioned the size of these earnouts, so the data you're seeing on the screen, these percentages are calculated by taking the maximum potential earnout payout and dividing it by whatever was owed or whatever was paid at closing. So it's not a percentage of the overall transaction value; it's a percentage of the guaranteed money paid at closing. And you can see, usually less than 50%, but interesting in the current market, Jon, you mentioned you're seeing some deals where maybe it's a larger earnout than the guaranteed upfront payment. And I get how do sellers get comfortable with that structure? Because that's a lot of potential risk on the sellers, right?
It is. It's the situation where, typically the company is running out of money and it's that or wind down. And the VCs would like to, have the employees continue with a job and have a potential for some return versus, paying to wind down the company.
Oh, interesting. Okay. Yeah, and I think, and the data is reflecting that. So you can see 2021, 2022, things were kind of plateauing right around 30%. But in 2023, it's closer to 40%. So I think you're right. Maybe some of these earnouts are maybe kind of sticking in that longer term 30% range. But yeah, maybe it sounds like there's some more distressed deals out there, where targets are maybe pulling that average up or that median up a bit. The interesting thing about the size of these things. So in 2020, of course, when the pandemic hit, the size of earnouts went up. In 2023 is going to be it looks like another bump up in the size of these earnouts. So we'll kind of see coming out of 2023, this will be a data point that we'll want to watch to see, if that comes back down or if, we continue to see such a high prevalence of earnouts. For the length of time that the contingent consideration is tied up on a median basis, it's about 24 months. Vast majority of them are going to be 3 years or less. Generally, I think, Anna, in our observations in terms of earnout achievement, generally, we usually see shorter performance periods equating to a higher level of success. Meaning, the metric gets hit and the sellers actually receive the payout. But just sort of curious from what you see and how these earnouts actually get, monitored post closing and maybe, renegotiated in some cases or sort of discussed in good faith with the buyer. But just curious, what sorts of things do you see on earnout structures that maybe lend to a more successful result? Or on the flip side, are there things you see where on these earnout structures, where immediately you kind of see it as a red flag or something that's potentially problematic?
Yeah, I think there's a few points to hit on that, Kip. One of the reasons that earnouts are more successful when they have a shorter period of time is often because a management team or a set of key personnel from the seller will stay on with the buyer who are really motivated to help the buyer hit these earnouts. The more time that passes, the more likely that there's attrition, key people leave, there's turnover, institutional knowledge is lost. And so I think that's one reason that having your management team stay on for the length of the earnout period helps to achieve the earnouts. Sometimes this ends up leading to issues where if a buyer decides to terminate some personnel from the management team before the earnout is achieved or before the period has ended where it can be achieved, that's something that might lead to a post-closing dispute between the seller and buyers because a question arises of if the people were let go for cause or if potentially one of the reasons was because a buyer knew that it would stymie the potential for an earnout for sellers. So that's one issue. I think another thing that arises that has to do with, for all the deal lawyers on the call to consider as a drafting consideration is even if an earnout is clear and agreed upon, let's say it's an annual recurring revenue threshold that has to be met over a course of 12 months, 24 months, 36 months post-close. Let's say there's a disagreement on whether that threshold is hit. The drafting considerations to keep in mind are the information rights. What are the sellers allowed to request and are entitled to get from the buyer? Which documents? Are they allowed to audit all the financials or not? So being sure to negotiate those provisions of sort of informational rights can have a huge effect on whether you have enough information to dispute an earnout being achieved. And another one is who gets to decide if there's a dispute, because sometimes you have to go to Delaware Chancery to file a lawsuit over a dispute of whether an earnout has been met. But other times you'll see a provision negotiated that says the parties just pick an independent third-party expert who gets to decide and their decision is perhaps non-appealable. And so your potential for winning or losing such a dispute can often depend on who gets to decide. And so that's another key drafting consideration that can have a huge impact, even if the actual question of what are the thresholds is something that's agreed upon by both sides.
Yeah, there's our theme again, right? Careful drafting. Always a very good point. Yeah, and I think the information rights that you mentioned, Anna, I think that's really important too. And we do. The data is not on the slides, but about 90% of deals with an earnout structure have some language around reporting rights. And like Anna was mentioning, right, that can be really important for the sell side post-closing to be able to monitor earnout performance, maybe not be surprised when the end of the performance period comes up and maybe the earnout wasn't hit, maybe it was, or it was partially hit. If the sellers were sort of brought along and were informed, maybe they won't be as shocked, won't have that major emotional response. Whereas just all of a sudden out of the blue, if they're just told, nope, the milestone didn't hit, you're not getting that payment, right? The reaction can be pretty different. So John, I'm curious, like your approach, kind of thinking about it both sell side and buy side. Clearly there's benefits for the sell side, but on the buy side, I think buyers, because of that issue where you don't want to sort of surprise sellers with a missed milestone at the end of the period, it seems to me like buyers, could benefit them to have sort of well-defined information and maybe even like access rights defined in the agreement. When you're negotiating these earnout structures, do you often include language around information rights?
Yeah, I think, it's generally, you don't want them to be able to, get information that is unrelated to the calculation of the earnout, and you don't want them to have oppressive rights in terms of creating work that you're otherwise not going to do. But I think regular quarterly or monthly reporting on the achievement, progress towards achievement of the earnout, even if the earnout is only paid on an annual basis, is good, so that everyone kind of knows where things are trending.
Yeah, I think that's good advice, and I think it's good when the parties sort of work through those during the negotiation phase, as opposed to trying to figure that out post closing. Because generally, right, buyers are probably going to have a little bit more leverage post closing, particularly if the agreement language is more ambiguous, or even a little ambiguous. So yeah, I think that's good advice, and it's behooves both sides, right, all parties involved to think through these issues and draft clear language. Kind of along those lines, that in addition to information rights, I think sort of the efforts language that might get imposed on buyers, in terms of like how much effort and budgeting and resources they need to put behind achieving achieving the earnout. These have sort of, the data on this has sort of been interesting. So on the left two bars on the screen are the two covenants that buyers might agree to. The one on the left being running the business in accordance with the seller's past practice. So basically buyer agreeing that they won't drastically cut budget or lay off workers, things like that. Oftentimes that's agreed to if the buyer is going to keep the existing management team in place. And so interestingly, even though this is somewhat seller favorable language, and the 2022 market, we saw more buyer favorable swings, this data point actually went up from the 2021 market when it was truly a more seller favorable market. 18% of deals with an earnout in 2021 had this covenant to run the business in accordance with seller's past practice, compared to 23% last year. And I think, even though that seems like a bit of a seller favorable trend amongst a buyer favorable market, I think what's probably going on there is the fact that we saw more financial buyers last year. And those financial buyers more likely to keep the existing management team in place. And so it makes this covenant a little bit easier to agree to. The next one over, though, that's the covenant to run the business to maximize the earnout payment. This is very seller favorable language. Very rarely do we see buyers agree to this, certainly in a buyer favorable market. The 1% you see on the screen for deals last year, we're being generous. We're rounding up from literally one deal that included this language. In seller favorable markets, a little bit more likely, about 7% of deals in the 2021 market included this quite seller favorable covenant. Additionally, we see language around like a CRE, a commercially reasonable effort standard. We see that on about 30% of deals. The most common efforts language we see is something along the lines that, buyer agrees they won't take any action, the primary purpose of which is to hinder the performance of the milestone. So John, maybe starting with you, when you're thinking about efforts language, from either buy side or sell side, what are kind of the considerations here? And it seems to me that, this is something that the parties really need to, A, have a pretty good understanding of the target's business and how it operates, and B, what their true intents are in terms of achieving the earnout. But just curious your approach for negotiating efforts language on these earnouts.
Yeah, I think just this slide alone kind of highlights why earnouts are litigators love earnouts, I think, because there's a lot of room for dispute as to what efforts are being taken and what the intention is behind the efforts. I think, as you mentioned, the sort of baseline is, and most people will always agree to this, the buyer is not going to take any action with the intention of purposefully avoiding the earnout or purposefully missing the earnout target. That's sort of the baseline, and then everything above that is better for the seller. Oftentimes we'll want to get them to the buyer to agree to operate the business in accordance with an agreed upon budget. That sometimes, there's always examples of, well, what if something happens and we can't comply with the budget, or what if X happens? And so whenever there's an earnout, I always advise the clients that there has to be a lot of trust between the two parties, and you need to get to know the buyer or the seller beforehand, because it's, regardless of what the contract says, it's often built on trust and the parties actually agreeing that this is a metric that's beneficial for both parties. Of course, we're gonna try to achieve this metric and do all that we can to achieve this metric. That's why, revenue can be, revenue is great from the seller's perspective, but the buyer may not want to maximize revenue because they need to conserve cash. And EBITDA is easily manipulated. If you want to grow the business during the course of the earnout period, EBITDA may be lower than it otherwise would be because the buyer wants to grow. So there's always all these considerations that are taking place on both sides. And I think, this is why there's so much more back and forth on an earnout, because you're trying to get these provisions put in or taken out depending upon which side you're on.
Yeah, and I think you're right. The parties taking the time to really think through these, carefully draft for them. It's really important. As my therapist loves to say, you got to do the work. And when it comes to earnout provisions and structuring them, this is where the work is. And your point about and I want to ask you about, because right, earnouts are fraught with post-closing conflicts. And so specifically, Anna, curious for your general thoughts, but also, specifically the CRE standard, a commercially reasonable effort standard. If the earnout isn't hit and there's a CRE efforts standard included in the language, is that pretty much just guaranteeing litigation, or is that not always the case with CRE?
Whether you'll end up with litigation depends on a lot of other factors, more than just what are the efforts requirements of the buyer. It will depend on how strongly do the sellers believe that this actually, was hit or could have been hit, but for the effort of the buyers. How much of a war chest do we have to take this to a dispute? To my earlier point, who gets to determine this? If the merger requires a 3-arbitrator panel of the AAA, you're going to need a huge chunk of cash just to commence a dispute, versus if you're just in court, it's a cheap filing fee and so on. But I do think the commercially reasonable efforts clause does increase the likelihood, because there's a lot of room there for fighting. And one thing I thought of when Jon was speaking is, I have a deal where there is a commercial reasonable efforts clause that I'm sure was very heavily negotiated by deal counsel. But then later on in the merger agreement, there's a clause that no one remembered was there that says something like, the parties agree that buyer has no common law or contractual duty of good faith and fair dealing to the sellers. So on the one hand, we have an earnout provision that requires commercially reasonable efforts, but there's an overall disclaimer of the duty of good faith and fair dealing on the part of the buyer. That's the kind of stuff that the litigators love to have in a lawsuit, because what does that mean? Why did they write that? And that's going to be the source of a lot of motion practice and a question of law. So the point of bringing that up is sort of, don't miss the forest for the trees. The whole contract matters, not just what's negotiated in the earnout provision efforts clause. But a shorter way of answering your question is, yes, that CRE language is going to create fodder for dispute.
Yeah, that's fascinating. The sort of conflicting language, or the parties forgot that other language was in there. Unfortunately, that does happen on these deals. And so, I think litigators, right, the first thing they do is they're going to read that contract cover to cover, right, and they're going to look for any ambiguities, because that's really what allows them to hinge. They can hang their hat on that peg for their argument. So it's tough to avoid. As a transactional attorney, I don't think any of us that are transactional attorneys can say we've never had that happen, where a clause got left in that wasn't supposed to. But always a good reminder to try and avoid those when we can. Just a quick note on legal structures about our data set. Generally, we do have a sort of an underrepresentation of asset purchase deals. We just don't get as engaged as a shareholder rep as often on asset deals as we do as stock purchases and mergers. But we wanted to include the slide today because I do think in the current 2023 market, we are seeing a little bit of an uptick in asset deals. And that's likely related to the fact that a lot of these companies are, in a fire sale mode, distressed, or, very much motivated to make an exit, kind of given their current cash position. So just, Jon, just generally wanted to ask, are you seeing more asset deals? And if the parties are approaching an asset deal, are there any kind of major considerations when they're thinking about the structure? Obviously, tax considerations, shareholder approval, that all plays into what structure might be best. But just curious, with a higher number of asset deals, are you also seeing that? And what does that kind of mean, particularly maybe for sellers if they're faced with an asset structure?
Yeah, I think, just explaining why your sample might be low is because the company still is there when there's an asset purchase. They're just selling the business of the company, but the company still exists. So they already have a decision-making structure in place, and they may not need a stockholder representative. I think we are seeing more asset purchases, again, with the sort of distressed environment on a lot of transactions, with buyers having more control. An asset purchase becomes a little bit more of a common structure. I think the same issues, there's earnouts with asset purchases, all of the same issues apply. It doesn't really change a lot of things. Sometimes like escrow accounts will go down because the buyer gets to pick and choose which liabilities and assets they're assuming. So some of the metrics may change a little bit, but all of the concepts are still going to apply.
Yeah, interesting. And yeah, I think you're right. Like, if it's just a sale of some of the assets, right, and you've got an entity existing post-closing on the sell side, yeah, maybe the management team is staying in place. Interesting. I think on the asset deals, we do get engaged as a shareholder rep. Sometimes it's sort of after the fact. They'll sort of come to us post-closing and say, "Ooh, yeah, actually, there's a big earnout on this one, and we'd like your help on that." So I think there are, instances. Just because it's an asset deal, maybe some of those traditional assumptions about them, kind of, Jon, to your point, like, depending on how the parties are structuring it, you still want to do kind of your full due diligence, even if it is an asset deal, for both buy side and sell side. But yeah, it can be advantages either way.
And if the company is going to wind down post-closing, which is often the case, but there's still the escrow that needs to be distributed or earnout that could be distributed, then that would definitely make sense to bring on a shareholder rep in those situations to manage that process.
Yeah. I do. There are a couple of questions coming in. I just want you to know, I do see them. We'll get to those when we do our Q&A at the end, because I do want to cover those. But I want to make sure we cover some of our additional slides here, just as we're kind of coming to the last 10 minutes or so of our webinar. So focusing on purchase price adjustments quickly, these are great to talk about just because they're so common, right? They're nearly ubiquitous on private M&A. Here you can see 94% of deals last year included a purchase price adjustment, right? Sometimes they're referred to as a working capital adjustment. This is where the company doesn't know its working capital position or its cash position, its operating cash at the time of closing, right? Because you've got pending accounts payable and things like that. So you estimate it at closing, and then you do an accounting true up maybe 60, 90 days post-closing. That's what we're talking about with these purchase price adjustments. So they're really meant to be, they're not meant to be contentious. It's just the numbers are what they are. However, they're not plug and play either, right? They're not the same for every deal. Every target financials are going to be different. And so you still have to customize the provisions to the particulars of the deal. And so one way you can kind of work through a lot of these issues and kind of go back and forth in terms of, okay, well, what types of GAAP interpretation is going to apply, what financial metrics are included or should be excluded from the calculations, is having the buyer participate in that estimate process that happens right around closing. So about 11% of the time, buyers have a contractual right to participate in that estimate process. I think in practice, though, it happens a lot more than that. Jon, would you agree with that? Do you see the buyers and the sellers kind of working together on the estimate or the peg for these PPAs?
Yeah, I think you're talking about post-closing or pre-closing.
Well, yeah. So the estimate that they would do, the pre-closing.
The pre-closing, yeah, I think they're working together to come up with where they think the numbers are going to be, so that they're, the best case scenario is no one is surprised, right? And so you don't want a seller being surprised by a big purchase price adjustment, because now they're part of your company and you want them to be motivated and you don't want a big deduction. So the buyer is trying to hit a peg where they think that there's going to be no adjustment, and the seller is kind of in the same boat. So I think they definitely are working together and coming up with the peg. And then post-closing, typically the buyer will prepare the initial estimate, and then the seller will have a chance to review it. But oftentimes the seller management is still involved in running the company, so they had insight into it beforehand.
Yeah, and I think, yeah, so for the post-closing calculation, I'm just going to skip ahead here. So, mention how you structure these things, very important. Usually, you want to spend the time to customize it to the particulars of the deal, including things like, what accounting methodology is going to apply, whether to exclude tax-related items or other financial metrics. All that really, those are, if there's going to be a threshold, a collar, usually there's going to be an overall cap. So we've got lots of great data on those, but I want to jump forward to how these things actually play out. Yeah, because John, to your point, I think sellers really should be paying attention. I mean, obviously they're going to be involved in that pre-closing estimate calculation, but they really should be paying attention to that post-closing calculation that buyer does as well. So this data on the screen, this is actually from our claims study that came out about a year ago, and we look at, we probably see more of these purchase price adjustments on private M&A than just about anyone out there. Like literally, like we've worked on thousands of these at this point. And so for the last couple of years, though, you can see there most likely is going to be an adjustment. About 88% of the time when there's a PPA on the deal, there is going to be an adjustment one way or the other. The yellow category, a little bit more likely that it's going to be a buyer favorable adjustment, meaning the buyer is going to, pull that money out of the escrow, or maybe there's a separate escrow for the PPA. But that orange category, that's when there's a surplus, meaning the sellers actually get an additional amount back from the buyer, plus they might get some escrow release if there was a separate escrow for the PPA. 40% of the time, that's actually up significantly. Just a couple of years ago, that was closer to like 29% of the time. So I think, 5-10 years ago, these PPAs really used to just be a one-way mechanism, right? They really would only benefit the buyer. Because it was the target company preparing the estimate, buyer said, hey, we need to have some sort of recourse if your estimate was way off. But sellers really couldn't benefit from an upside. Now, though, these really are two-way adjustments. And I think because they're a two-way adjustment where sellers can benefit from the surplus, maybe sellers that take a little bit more conservative approach to their calculations, knowing that if they're way off, they're not leaving money on the table because they could potentially benefit from that surplus. I don't know, John, are you noticing that like in sort of conversations with your sell side clients, since when it's a two-way mechanism for the PPA, are they a little bit more conservative?
I think oftentimes these are structured where the parties know there's going to be an adjustment, but because they don't know the answer. And so, for instance, like AR, for instance, where the seller wants credit for the AR, but the buyer doesn't believe that it's necessarily real AR. So they're going to say, okay, we'll give you credit for AR at closing, but we're going to recalculate AR in 90 days. And if it hasn't been collected by the 90-day period, you're not going to get credit for it, or you're going to get a reduced amount of credit for it. And so they know there's going to be an adjustment because it would be impossible for there not to be, and they just don't know which way it's going to go.
Yeah, and I think that's the goal, right? Is where you know there's going to be an adjustment. You just need those final numbers. Hopefully, you're not fighting about what those numbers actually are, what the resulting adjustment is going to be. But just to put like a little finer point on why I think it's good for sell side to really pay attention to these PPA calculations post closing. On the very bottom there of our key points. So when buyer feels they're owed an adjustment and we receive that notice as the shareholder rep, we end up contesting or maybe pushing back on buyer's calculations about 40% of the time. And when we do push back, it reduces the amount of their claim or the adjustment by $1 million on average, or $328K on a median basis. So, depending on the overall size of the deal, I mean, that could be real money, right? That the sellers are potentially leaving on the table, if they're not paying close attention to these calculations. All right, just since we're kind of short on time, I want to jump ahead just a little bit to our indemnification claims data. And particularly getting some insights from Anna on this, because she gets to see these indemnification claims every day. So on this screen, we can kind of see the types of claims that we see come in post closing. So about a third of deals that we're engaged on see some sort of indemnification claim. On the left, you can see the broader categories. Most common, it's going to be a breach for rep and warranty. And on the right, there's a breakdown of the specific types of reps for which breach is being alleged. So you can see the big takeaway on the right there is a lot of tax claims, and that's up significantly from data that we've reported in the past. So Anna, why are there so many tax claims? What's going on with that?
The most common type of tax claim that we see tends to be sales tax issues, sales and use taxes, where if it's a tech deal, for example, this was a small startup at some point, they sold something, they didn't realize this was taxable under the statutes of various state taxing authorities. And so you end up where after the fact, it's just inescapable that the buyer, which might be a more mature entity, is going to want to true up, get these taxes paid, enter into some sort of potential voluntary disclosure agreement with the states to fix what were maybe gaps in a lack of paying state sales and use taxes. So that's what we see most often. And that tends to be a collaborative process, although sometimes it can be contentious. But that's just a matter of you can't escape the tax man in the end. So that's what we see a lot. Other times, particularly if there's a cross-border issue, if it's a European deal or something, there might have been taxes owed in other states that aren't just sales. In other countries that are not just sales and use taxes. They might be just very unique taxes owed in some jurisdiction that were not thought of. And so things like that come up very, very often. And I think it's the answer to why is because taxes are everywhere for everything.
That's right. Death and taxes. We can't escape it. That's right. And so, yeah, so that's interesting, right? And your point about, they might be aware, like the parties are probably going to have an idea, particularly with these sales, kind of the voluntary disclosure agreement type claims that might come up post-closing. And another trend we're seeing in the current market, 2022 somewhat, but certainly in 2023, is because deals are taking longer to close, buyers are spending more time on due diligence. And as a result, they're maybe uncovering more of these potential post-closing matters or claims that might come up, including tax issues. So Jon, are you seeing that on your deals? Are buyers sort of, because they're doing, are you seeing more thorough due diligence? And as a result, are you seeing the parties sort of having to draft for additional known liabilities or, kind of pending matters that are made aware pre-closing?
Yeah, it's not unusual, even like on a RWI deal, which are pretty common, for there to be like a separate tax escrow, like for knowing that there's these sales tax issues out there and that they're going to need to get resolved post-closing. We've seen that in several transactions where they're addressing it up front, that they know there's going to be an adjustment. Again, they don't know what it's going to be. So similar to a working capital adjustment, they'll have a tax holdback or a tax escrow.
Yeah, and I think that's true. The data is definitely showing that too. We're seeing way more, a higher prevalence of these special escrows, particularly on deals with RWI, right? Because RWI might have a smaller general indemnity escrow. And we didn't get a chance to talk about RWI too much on this webinar today, so I apologize about that. But yeah, I think that's a really great point that we're seeing additional escrows, or in some cases, maybe the buyers are just padding the escrows. And so for those of you who are kind of deal makers out there or setting expectations with deal makers, in the current market, escrows are, not only are we seeing more earnouts, but we're also seeing more customized and larger escrows as well. So we're just about out of time, and I apologize we didn't get to all the data that we wanted to cover today. We do want to make sure we get to your Q&A, so we'll get to those in just a minute here. But I want to give a huge shout out to our two panelists, Anna and Jon. Fantastic job. I do want to give you one last word, so I have a final question for both of you. Anna, we'll start with you, and I apologize putting you on the spot a little bit. But in our role as a shareholder rep, we always encourage our clients to set up, the sell side clients to set up an expense fund. So just as maybe closing comments, what are the true benefits of having an expense fund for a private M&A deal?
The main benefit of an expense fund is that it gives the selling shareholders flexibility for the unknown things that they didn't foresee when the deal was negotiated. If you don't end up needing the expense fund, all of that money is going to come back to the shareholders anyway. And so you're going to get that consideration. But not having a sufficient expense fund in place sometimes cuts you off at the knees if you really do have a good reason to maybe file a lawsuit, or if you want to take on the defense of a third party, let's say litigation that's filed post-closing, and you really wish you were controlling the defense of that rather than letting buyer do so, you can only do that if you've set yourself in the right place, funding an expense fund sufficiently. And in the end, if you don't use it, no harm, no foul, you get that money back anyway. So you might as well give yourself the chance before those things come up post-close.
Yeah, the last thing you want to have to do, right, is try and fundraise for an expense fund, try and get money from the sellers post-closing, right? It's quite a big headache, right?
Exactly. And we know why people don't want a huge expense fund. We get it. It's just that ends up leaving sometimes the selling shareholders without a lot of options in the post-closing period.
Yeah, true. All right. And then Jon, for your final question, I'm going to make you get out your crystal ball. For the last 6 months, we've been hearing a lot of optimism. The market's going to turn around. We're going to see a spike in deal volume. So we're a few weeks into Q4. We're not quite seeing we're seeing some signs of maybe a little bit of uptick in activity, but not that hockey stick moment. So what's your prediction? When is the market going to turn around? When are we just going to see a rush of deals happening in private M&A?
I think we're seeing an uptick in deals for profitable companies, many of which are sort of service oriented. We also are seeing opportunistic buying of distressed assets or dispositions of assets of acquisitions that didn't work. I don't know when the strategic buyers are going to go out there and start buying these venture-backed companies that have hit their B and C rounds, and that's really what we need to change the market. That part of the market has dropped off almost entirely of the sort of positive acquisitions of private venture-backed companies. We're just not seeing that in the market right now. So I don't know. I hope it starts Q1. I've heard some estimates of Q1. I think that'd be great if it could come around that quick.
Yeah, I think that's the fair answer. None of us really know, but I think we're all holding out hope that it comes sooner than later. All right. Well, again, I just want to thank everyone for joining us. We're going to do Q&A here, but just a reminder, CLE is pending. You'll receive a follow-up email with a copy of the slides. And a huge thank you to our partner KO and our panelists today. So looking at our questions that have come in, first, Jon, for you, when you have a deal where there are multiple buyers competing, right? So maybe the sellers is running an auction process. How does that kind of deal-making environment differ from when it's just one buyer involved?
Yeah, it's always seller favorable to have multiple bidders involved. I think, one thing that happens frequently is that RWI becomes a lot more likely to be achieved because that's kind of an easy give on the buyer's standpoint in terms of providing a benefit to the sellers of knowing that they're going to keep most, if not all, of their consideration that they're going to get at closing, and they're not going to have to wait 12 or 24 months to get the final 10 or 15%. So that's, I think, when there's multiple bidders, you oftentimes see RWI insurance. And just across the board, the terms get better because they know they're competing against someone.
Yeah, I think that's exactly right. And, when you're looking at the data specifically, if you look at 2021 data, you'll see a lot more seller favorable terms throughout all these different data points that we track. I think for the exact reason that there was a lot of competition among buyers in 2021. It was just a really seller favorable, really hot market, a lot of competition among buyers. And yeah, we saw that play out in sort of how these deals were negotiated. So maybe, more walkaway deals, right? Where the buyers, general reps and warranties didn't survive closing. Anything buyers could do to kind of sweeten their bid, right, when they're competing with others. So yeah, obviously going to have a seller favorable effect there. What about if the assets being purchased or the business itself being purchased is really heavy on IP? If there's a lot of intellectual property involved, how does that affect a deal?
It's really more of a diligence issue, and there's oftentimes, the issue on the IP rep is whether you're responsible for only known patent infringement or known and unknown, whether, who's taking on that risk of unknown patent infringement. That one, I think, is one that was not historically covered by reps and warranties insurers, but now is. And so it's become a little bit less of an issue because IP is often, included as part of the RWI package. So it becomes a little bit less of an issue. But again, most buyers aren't going to do like a full patent search to know whether or not there is sort of this unknown potential infringement out there. So it's a lot of risk shifting, and in this market, the risk is typically falling on the sellers, unless it's an RWI deal.
Yeah, and unfortunately, right, there are a lot of those sort of patent trolls out there, right, that can come out of the woodwork, especially if the deal ends up being publicly disclosed. So that might be another thing to consider. All right, well, the last question was about if we can just explain kind of why life sciences deals were excluded from our earnouts data. So I'll just quickly mention here. So life sciences deals, like particularly biopharma, so like, you know, drugs. Usually how the industry works in biopharmaceuticals is you've got the big players, right? The Mercks and the Pfizers, who are constantly building out their pipeline of drug offerings, right? You know, they're bringing drugs to market. That's how they're making profitability, but they're always keeping an eye, especially because, you know, the patents run out on these medications. They're always keeping an eye on that ongoing pipeline. And so how they fill their pipeline is by acquiring other companies that have promising or have drugs that show promise. So usually biopharma, they're being acquired, you know, at some point during the drug development. And so there's still a lot of uncertainty around whether that drug will actually be effective, right? What the outcome of those clinical trials is going to be, whether it's actually going to get FDA approval or approval in other jurisdictions. And then even if you get all those things, there's still the outlying question of it may or may not be commercially successful when you put it out to market. So because of all that uncertainty and the fact that these buyers are usually buying, you know, a preclinical or maybe a phase 1 or phase 2 clinical drug that's in that phase of development, they're going to want to tie a portion of the consideration to an earnout based on whether that drug continues to progress through that development cycle. So that's why earnouts are so much more common on life sciences deals, and they just behave, and as a result, just those deals behave and are negotiated differently. So we actually do put out a separate study just for life sciences deals. It actually just came out about a month ago. So if you work in life sciences, it's on our website for free. I definitely recommend checking that out because, yeah, life sciences deals, they're sort of a genre of their own. John, I don't know, do you work? I know you do like food and beverage and a lot of like technology, software,
We do
SaaS,
some
that kind
life
of thing.
science deals also.
Okay.
Yeah.
Yeah. Do you have any thoughts on life sciences deals? Any words of advice?
I mean, I think you covered it. You covered it pretty well. And the metrics are not revenue metrics typically; they're development milestone metrics. You know, and you know, there are life sciences deals that are done without earnouts, but they're uncommon, I think.
Yeah, it's about like 60, anywhere between, like, depending on the year, 66% to about 80% of life sciences deals have an earnout. So that compares to like the 20 to 30% on all other M&A deals. So yeah, pretty dramatically different. All right, and with that, I think we've gotten through all of our questions. So again, thank you so much for joining us today. Thank you, John and Anna, for being excellent panelists. Feel free to reach out if you have any questions and look for that follow-up email. Otherwise, enjoy the rest of your Wednesday, and we'll see you next time. Thank you.
Thanks, Kip. Thanks, everyone.
All right, welcome. Thank you for joining us. We're getting started in just about 30 seconds here. I see a few more people are joining. We're so glad to have you with us today. A lot of great data and insights to talk about with our panel.